to see friends as well as new faces. For those who don't know me yet, my name is Steffanie Yuen. I head up the business of Endowus here in Hong Kong. So very excited tonight to bring this event to all of you in partnership with HKSI, as well as obviously thanks to our venue sponsor TEC, hosting us at this beautiful office at their AIA center. They also have locations across Central. If you guys have any co-working or office needs, they're a really, really great provider. But tonight, we're very excited to have brought to you a panel of experts to really talk about a very topical topic, which is the Hong Kong-China equity markets. Before we dive into that, allow me to just spend a few minutes to share about you what is Endowus, what we do, before we dive into tonight's panel. So briefly about Endowus, for those who know us would know, we really pride ourselves to be a conflict-free wealth advisor. And what do we mean by conflict-free? It means we don't take commissions from product issuers. We are what we call a fee-only model. So we always use the analogy of going to the doctor. So when you're sick, you go to the doctor, you tell the doctor your symptoms, the medical history, and the doctor prescribe you the most sort of suitable medicine based on what you told them. But unfortunately, in financial products, this is not the way how it's done. It's using back the analogy of a doctor. The doctor is actually, whoever is selling you financial products, actually compensated with commissions. It means the doctor's prescribing you medicine and they're getting paid by drug manufacturers. So you can see potentially there is potential conflict of interest. So at Endowus, we really want to bring the independent, conflict-free advisory model to our clients to really be 100% sure that when we recommend products and solutions and portfolios to you, we can be very confident to say this is because we think this is best for you to achieve your investment objectives, not because we get big fat commission kickbacks from any of the product issuers. So we're here to bring this conflict-free model as well as what we call our three USPs: evidence-based advice, institutional access, and low fair cost, which I'll touch upon very quickly in the next few slides. But for those who are not familiar with us, we started out in 2017, and we're very proud to share that although we're still majority owned by Endowus employees, along the way, we've been supported by some of the biggest institutions to become our shareholders. So we count the likes of UBS, Citi, MUFG, EDBI, which is the Singapore government's Economic Development Board's investment arm, as our shareholders. And our group AUA right now stands at $6 billion, servicing over 200,000 clients across Hong Kong and Singapore. So for those who don't know, what our name actually carries our mission, and what it means by Endowus, it means endowment investing for all of us. So for those who are familiar would understand, endowments are institutional investors. And a lot of our founding team, our team members, actually came from the institutional investing world. And we realized the way institutions asset allocate is very different from retail investors. So when we say Endowus brings endowment investing for all of us, when you come to us, do not expect us to give you stock tickers or what stock's going to go up tomorrow, next week. We're all about bringing this institutional framework, helping clients really do proper entity asset allocation. And I will share in this slide what we mean. When a client comes to us, we'll start with asking you, what are your investment objectives? What are your life goals? And we think each and all of us can have different life goals. And I think this is something that I find it very powerful. When I first started out my wealth journey, I think in Hong Kong, we always just look for that one stock or one investment that will do the trick. But in fact, our life, we can have different goals. We can have liquidity pocket of our wealth. We have longer term goals, retirement, sort of longer legacy planning for our kids. We have medium term goals, whether it's preparing for our first mortgage, buying our first house, buying for our first car. These are all different objectives, and you can create investment portfolios scientifically based on each of these objectives. And your overall asset allocation will be a sum of all of these goals. And this is what we mean by scientific asset allocation. And really proliferate this core satellite investment approach. You have your core goals, generational wealth or retirement or liquidity sleeve settled, then you can think about satellite goals, whether it's to punt on crypto, punt on recovery of China equities. But we really think investing shouldn't be speculating. You should think about it scientifically. If you're interested to learn more about how this can be applied to you or your family, feel free to reach out to our client advisors. And how do we help clients do asset allocation? We use the best-in-class building blocks, and us as Endowus, we focus on the wealth management, giving you the best advice. We will not manufacture the products. We will partner the best fund managers, which we've invited onto this panel tonight, to bring their best-in-class products to help become building blocks of your portfolio. And some of you would know, we try to make sure we lower the cost of accessing these strategies by offering institutional share class, and if we can't do that, we offer all the 100% trailer fee rebate to our clients, and those savings are very, very important. And this slide again shows why we're so obsessed with helping clients lower cost. It's because just 1% difference. We often only focus on compounding effective returns, but actually cost over compounds. 1% difference in returns over 30 years, assuming, say, you have a 8% annualized return. For those who invest in the US stock markets, it's probably on the past 20 years, it's on average a 10% annualized return. But let's say 8%, and over 30 years, just 1% difference in fees could cost you 250% in investment loss. And this is why we're so gung-ho on making sure that we help clients lower cost at every stage of their investing. We don't charge any subscription fees. We don't charge sort of clients the highest retail share class. We make sure we help clients lower the cost to help them maximize their investment success. And so for those who are not familiar of us, we serve a wide range of clients. And I think this is really the beauty of a technology platform. We serve individuals, and you can start an account with us, completely everything online onboarding with $10,000 Hong Kong dollars. We also serve professional investors, giving them access to, say, best-in-class alternative products, whether it's private credit, private equity, or even hedge funds. We serve family offices, institutions, charities, endowments as well, all in one platform. So feel free to try our platform if you haven't yet, and recommend any sort of this wide range of potential clients you think might find us too useful. And with that, I will like to invite my panelists onto the stage, and we can get started on this panel. It's okay, free seating. It doesn't matter.
That's for you.
I'll sit on the very left. Okay, it works. So to kick off this panel, maybe I'll start with asking the panelists just to do a quick self-introduction, your name, what do you work, and what do you currently look after? Start with Tessa over here.
Hi everyone, good evening. Very happy to have this chance to speak to you today about China Hong Kong equities. My name is Tessa. I'm from Allianz Global Investors. I'm a senior product specialist covering China equities with Allianz Global Investors over the past 7 years. So looking forward to your questions later on.
Share this. Good evening, everyone. My name is Nicholas Yeo. Maybe from my accent, you can tell that I'm from Singapore originally, but I have lived around the world in my 24 years with Aberdeen, starting with covering Latin America. Don't ask me whether I speak Spanish. I don't speak Spanish. But I returned to Asia back in 2004. Moved up to Hong Kong since 2007. So I've been here for close to 18 years now in Hong Kong, covering China, and we have a team in Shanghai as well. So I'm heading up the equities team covering Hong Kong and China. Thank you.
Hi, good evening everyone. My name is Francesco Chan. I'm an investment specialist within our emerging markets and Asia Pacific equity team at JP Morgan Asset Management. I've been looking at Asian equities for the last 10 years. My role typically within JP Morgan is to deliver our insights, distill the market noise and market signals for our clients to help them better asset allocate into EM and Asia. I'm looking forward to speaking with everyone and sharing our views.
Thank you. So we do have a panel of experts. So I have some prepared questions for the panelists, but just to highlight, there's a QR code behind me. At the end of the session, we're also going to open up for Q&A, so feel free to leave your questions on Slido. I have an iPad, and I'll look into the Slido when we move into Q&A. But let's kick off this panel with the first question. So everyone is here because after 2-3 years of very disappointing performance, and for some of us it's very close to heart, it seems like Hong Kong and China equities is looking at a rebound. So we've seen Hang Seng Index has rebounded close to 20% from the really, really low bottoms in late January. CSI 300 also rebounded double digits from their very, very bottom in February. And so maybe I'll start with Francesco. What happened in the past 2-3 years? How did we get here? How did Hong Kong China equities sort of go through this really sort of turbulent time? And now it seems like 2024, we're looking at a recovery. What has been the catalyst for this recovery so far?
Thank you, Steffanie. So I think when we look at Chinese equities over the last 3 years, it's really been quite difficult. And actually, it's the first time in 22 years in which Chinese equities have fallen 3 years in a row. So what's dragged on Chinese equities in general? In our view, it's basically been a self-inflicted series of issues caused by the government when they were trying to tighten policy over the economy. And it was basically, in our view, a miscalculation of a lot of the policies. But in the reality of things, with the overarching objective of trying to establish a more balanced and more sustainable economic growth model for the long term. Now let's rewind a little bit in terms of what's happened over the last couple of years. 2020, everybody remember COVID. That's when it happened. First started off with China, and actually China did a very good job in terms of containing COVID in the first couple of months. And actually by April 2020, China was already reopened. Everything was up and running normally. The economy was actually doing pretty good. The private sector was booming, and that's when the government thought, is the private sector getting a little bit too big to fail? And they started basically to tighten grips in terms of the private sector, starting off with education, and then moved on to the e-commerce platform, and then to the real estate sector, where they had an overarching guiding principle of real estate is for living and not for speculation. In 2021, there was more clampdown on real estate. What we saw was a couple of the real estate developers started to default on some of their bond payments. That led to a downward spiral in the property sector that we see today. 2022, when the rest of the world was starting to exit out of the COVID period, China got a widespread of coronavirus infections, and basically there was a nationwide lockdown that extended towards the end of 2022. And that obviously killed all consumption, killed all manufacturing, killed all economic activity. Towards the end of 2022, the government decided to open up. There was a very short burst of optimism in the fourth quarter of 2022 and the first quarter of 2023. In terms of whether China will follow the path of a lot of the Western economies in terms of rekindling economic activity when they open up. And after a couple of months, it was clear that after the very stringent lockdown during the COVID period, the consumption patterns, the consumption behavior of the Chinese consumers have really changed, and economic fundamental issues of real estate sector still really remain, right? So it was clear that China was going to take a little bit longer to recover. And fast forward to 2024 year to date, we've seen a little bit of a recovery. And why is that? It's because the government has realized the need for additional stimulus to really boost up the growth and boost up the economy of China. I guess the big rhetoric right now within the market is whether it's too little and whether it's enough. think we're looking at real estate. We still think it's going to be slightly a small drag on the economy, although it is bottoming out. Consumption from the consumers, it's still not as strong. I mean, not as strong as probably an understatement. It's still relatively weak because of the real estate sector and the wealth effect. When 60% of your or Chinese person's wealth is in real estate, and they don't see the outlook of property prices going up, then they don't really feel the willingness to spend. And that's basically the wealth effect, which has dampening the consumer confidence. And lastly, I think the stimulus which is being rolled out is quite incremental, bit by bit. But what we're seeing is it's slowly making its way into the economy, and therefore the market is starting to pick that up. And therefore we're seeing a little bit of a pickup in the equity markets this year.
Thank you, Francesco. That was a walk down the memory lane. I also have images floating on my head as you were recapping some of the events. So we looked at what happened, how we got here. Let's dive into looking forward. I think, Francesco, you gave us a sort of preview, right? For the longest time, China real estate really dominated headlines. We have a lot of developers, again, dominating headlines. We've also seen new measures coming out from the central government. Maybe I would like to ask Nick, what is next for China real estate? It's still a big portion of the China economy. Kind of Francesco mentioned, is it enough? The measures that's sort of mentioned, are we going to see a bottoming, or are we going to be able to see a rebound? What's your view on this?
How much time?
Let's cap it to a few minutes. Let's say less than 4 minutes.
Because this is a huge topic. Real estate, as we know, used to account for 25 to 30% of GDP. It's a pillar of GDP growth. It's an engine that is important, but this engine is stalling big time. Most of us live in Hong Kong, so I presume that you have some knowledge of what's going on in the north with the real estate. In a way, it's not that dissimilar in Hong Kong, right? I went to a church event yesterday, and someone celebrated being able to sell an apartment, sell and rent. So it's like, people are rushing to get out, right? So how to break that mindset, I think, is key. And I would not want to give you false impression that this is something that can be resolved overnight. We have spoken to companies that I cannot give you the name in our company visit, telling us that these are some of the banks are saying that this could be 3 to 5 years or even longer resolution. If you look at other countries, to be fair, if you look at Spain, if you look at the US, how long did it take to get out of the housing crisis, right? At least 5 years, some even 8 years. When it was the peak of the property market, that was back in 2021, right? So we're only like 3 years into this crisis. So we still have quite a long way to go. And just to give you some background, last year we have been seeing a lot of policy from the government to stimulate the demand side, encouraging more people to buy. But that is like pushing a string, right? You're not hitting you're barking up the wrong tree. In other words, people are not buying, not because of the lack of stimulus. It's not the demand side, it's the supply side that needs to be tackled. So May 17th or 17th of May, sorry, I should use the British way of, given I just did a roadshow in the US, I was saying May 17th of May, that was an important policy that came out. That was a game changer in our view. It may not be very big in terms of the size of the stimulus, but it's a game changer in terms of tackling the root of the problem in China. It's not because people don't have the money to buy. It is because people are not willing to buy from private developers. Private developers are going to the wall. They are going bankrupt. And in China, it is a pre-sale model, right? Pre-sale meaning that you have to pay 100% upfront. And we still have houses not delivered that were paid upfront 8-9 years ago. You could see in the South China Morning Post, right? That was amazing. Someone walked up an empty house because he wanted to protest. That it it took so long for the developer to deliver the apartment to him. But he had to walk up and basically stay in that uncompleted home. But that is the problem that the government needs to tackle, which is why 17th of May, the announcement to not talk so much about the demand side, but more on the supply side. That is an important first step. So the strategy that they're going to use is basically to take out some of the inventory in the city, convert them into social housing, or what you call affordable housing in the West, which is basically similar to what the country that I come from, Singapore. Like 80% of the people live in public housing. So take it out from the private side of the market, and as a result, people will look at the supply side becoming smaller and smaller, and hopefully prices will stabilize. So that is the idea. It is finally tackling the supply side. In other words, the central government is becoming the builder of last resort. Just to add to Francisco, right? The reason why the market rallied, because the government is backstopping a lot of things, from the stock market and now to the property market. So by being the builder of last resort, right? Because the property developers cannot finish the product, so they cannot complete, and the government is now stepping in to complete the project and deliver some of the pre-sold apartment. So that mindset needs to be improved in terms of not willing to buy from developers. I think that is an important first step. But the elephant in the room is how many units are still sold or pre-sold but uncompleted. The estimation is about 20 million units, and what is the amount that's needed to complete roughly in the range of 3 to 4 trillion renminbi. So China may have to do some QE. Although China government always say they don't like to do QE, but they have to do some QE in order to help to support the completion of all these pre-sold units. But interest rate is low right now in China, so there is a good reason to do QE. So I'll stop there. And then of course you have further question on the property, which is an important engine, and we can continue to address that issue. But it's a good start. But we still need more policy to come out, and hopefully over the next few months we could see more positive policies.
Thanks, Nick, for giving us a concise answer. Before we move to the next question, I know there are new attendees coming in. There are still some seats in the front if you want to take a seat. But on to the next question. I think Nick mentioned that, real estate, good news, bad news, there are some green shoots. So what about the other engines of the economy, right? Historically, we always said the Chinese economy, there are 3 horse carriages, 三驾马车. So what are the other drivers? How are they looking? Government's been trying to promote consumption. Will that be able to compensate for this weakness in the real estate market, which seems like will take some time to absorb? Historically, exports also very important. And also, we've also seen China depend on investments as well. So maybe I'll ask Tessa, what about the other drivers of Chinese economy besides real estate? Are we going to expect, what kind of GDP we're going to expect now that the government's always stressing quality over sort of absolute growth?
Thanks for the question. Well, a quick answer to the GDP growth. Obviously, the target has been set as 5%, around 5% this year. And if you think about some of the statement by President Xi a couple of years ago, he basically said that he hoped that the GDP per capita for China would reach to a moderately advanced economy by the 2035. So that is equivalent to around 4.7% on average GDP growth to be expected till 2035. But honestly, I think these numbers may matter more to investors, but whether it's 5% or 4.7% or 4.5%, is not that important. The important message to me, I think 2 things. One is that what we observe is that the Chinese government really missed the target they set for themselves. So when Nick talked about some of the starting to step up of supporting measures companies that are hoping to see more, I think the GDP target would exactly be an incentive for the government to do more, because if you look at the past 20 years, most of the time they achieved the target except for themselves. The only exception was 2022, but that was due to COVID breakdown with the Shanghai situation. So 5% is not an easy target, obviously, this year, because unlike last year, they don't have a COVID reopening rebound event to easily achieve that. So with a 5% target in mind, I think that will continue to be an incentive for government to step up more supporting measures, whether it's QE, whether it's more specific measures, stepping up the amounts that central government will commit the local government to buy the excess inventories, for example, in property. I think that will be a room to look for. The second important message is that obviously China is moving out from the previous property leverage build growth model. And as Francesco and Nick also explained, this won't be a sustainable model going forward. We need new drivers to compensate that, because basically we just have a demographics change in China with the aging population. We don't need that much property going forward. But what could be the new drivers for China? China has been working on really hard on the innovation stuff. We have BYD everywhere. If you go to Shenzhen, cross the border over the weekend, and a lot of different models. If you go to the Shenzhen malls, you have AI coming up. But then this is still an emerging trend, as Nick mentioned, still a lot of excess inventory for properties. So this certainly will take time to digest when China goes through this painful transition from a property-led, investment-led model to increasingly focusing more on some of the other things like innovation-led model, which will in turn stimulate more on the consumption and the export side. Now, if you look at this year is not that bad for China because export has been doing well. But obviously, China cannot rely on export all the time. We have the US election coming, also another elephant in the room. This is a tricky area that may impact export going forward. So I think the long-term direction for China is really to work on the domestic consumption. Innovation will be the key to go as they work on the AI, the technology catch-up that will play important roles equally for export as well as domestic market. And more importantly, the government really need to relook at how they can encourage the private sector to come back. As what Francesco mentioned, they issue some really tough policies over the past few years on the private sector, which hurt the animal spirit. But if they need the animal spirit to come back, we need more clarity on the income expectation. We need more solution on the youth unemployment situation, and that will help China to really start to see some of the drivers on consumption coming back, not just riding on the export that we are seeing this year, because we are talking about this a two-speed recovery model in China this year. Export going well, producers enjoying, but consumers still lagging behind. So I think the consumption area will be the forward direction that China will need to look for.
Thanks,
And I guess maybe just to quickly add on to that, I think one important point which investors need to think about and not confused for is, economic growth does not equate to earnings growth. And for asset managers like ourselves, we want to be finding the companies which are delivering on earnings growth, because that's what drives stock prices in the end. If we're to invest on the basis of economic growth, we'll be investing in a country like Beijing, which is in South America, right? With last year, I think this year they're anticipated to grow at 30%. But investors invest in the US because there are strong companies which deliver on earnings. And we still feel, at least for us, we still feel that within China there are companies which are able to deliver on earnings in the long term.
Thanks, Francesco, for that. And I think this is a good segue, Tessa. I think all the panelists mentioned, and we really cannot leave a China equity markets discussion without talking about policy and regulatory environment, right? We mentioned there were sort of some maybe policy mishaps in the past couple of years that hurt sort of market sentiment. But recently, I think, particularly in 2024, we've seen a series of what we call maybe sort of a U-turn. We see governments publishing all sorts of different policies that are seem to be more supportive and more encouraging, I guess. Everyone's expecting, later this year we have the Third Plenum, which everyone was expecting last year and it got postponed. What should we expect going forward in terms of policies? Should we expect any sort of surprise on the upside, positive surprise from the upcoming big conference? What should we expect? Maybe I'll ask Nick to comment.
Fortunately, I don't belong to the CCP, so I don't really know what they will say. But most likely, roughly, 4 topics that are very important. By the way, the plenum is more for long-term planning, and it coincides with Politburo in July. Not all Politburo are related to economic matters, but the one in July is. So those are the 2 important sessions or meetings that you should look out for. But for the plenum, I suspect that the fiscal balance between the central government and the local government has to be sorted. Because this problem has been going on for too long. How much revenue share between the central government and the local government has to be, finally there should be some better planning. And also spending as well. Is it going to be spent by the local government or is it going to be spent by the central government? So some of these issues should be tackled in terms of broadening the base of the fiscal revenue. We used to be relying on land sale, but nowadays it's difficult to rely on land sales. If I say that the property tax is something that they will not be announcing it because of the problem with the real estate, but it should be in the pipeline in the long run as well, in order to broaden the fiscal revenue. And the other important topic is confidence, right? President Xi, I don't know whether you came across an article about him visiting even some of the business leaders from Hong Kong in Shandong. So that was an important meeting with business leaders. Basically, he's trying to portray that the leadership wants to know what is the problem with the private sector, and there could be some policy to help leveling the playing field between the state-owned enterprises and the private companies. So that is an important policy to look out for, whether there will be more action rather than just talk about supporting the private sector that has been hurt by what has happened, like Francisco mentioned earlier on, regulatory crackdown over the years. That was a few years ago, but it's still leaving a scarring effect, geopolitics as well. So the private sector needs to be supported and needs to feel that they are loved by the government. Yeah. So I think that's another important consideration. And of course, the planner will also tackle the long-term issue about demographics, right? Aging population, and that has to do with the stock market as well. In about 10 years' time, we're going to have an issue with the pension deficit, and if the stock market is not conducive for pension funds to invest in, it's going to be a real problem for pension in the long run, right? Given the aging population. And hence, there was a 9-point measures announced by the CSRC with the new regulator. In the West, I think when I went to Latin America, they call him the butcher, right? The butcher, because he's more like a headmaster, right? He doesn't like the fact that the stock market has been, in a way, abused by companies for fundraising reasons. And we suffer that as well as investors, right? If we do not participate in the private placement, we get diluted in the stock market. The dilution effect is pretty bad in the domestic market. So the 9 measures is basically trying to contain that kind of rampant fundraising by companies, and as a result, you have a higher return for shareholders. Of course, the talk about value up, paying more dividends to shareholders, similar to Korea, similar to Japan. If your neighbors are doing it, I think you are under peer pressure to do it as well. So the dividend has gone up 18% last year and still going up in terms of share buyback and dividend. So hence, this is important in terms of allowing more pension funds, local insurance funds to invest in the stock market in China. Otherwise, this pension system is facing a collapse. Maybe that's a bit too serious to
Any comments from the other panelists on what we expect on policy?
Yeah, I totally agree with what Nick mentioned. I think the other point I want to bring out, similar to what Nick already pointed out, is in the non-measures. It's really a significant change to our view. It's because in the previous direction for the financial capital market direction is more like building up more equity issuance. But what we have seen is that the equity issuance has been the headwind, one of the headwind to the weaker market over the past few years. If you look at the level of share buybacks compared to the level of equity issuance as a percentage of market cap in China, it's actually very interesting. The level of equity issuance significantly outpaced the level of share buyback. This is completely opposite if you look at US market or Japan market, where they have the share buyback significantly outpacing the equity issuance. So just as Nick mentioned, even the Chinese companies are making money, making return. This set of return has been diluted.
I think in terms of the demand side, it's still pretty robust. Now the challenge is basically on the supply side, right? So I was in Shenzhen a couple of weeks ago, and if you go to Shenzhen or you go to China now, you'll be able to see that a lot of the cars, they're differentiated by green license plates and blue license plates. Some of you are nodding your heads. And basically it differentiates between EVs and internal combustion engine vehicles. And you'll basically see that every other car is already an EV, right? And you'll be able to see brands from NIO, XPeng, Li Auto, even Huawei and Xiaomi have come to launch their own electric vehicles. So there are a lot of entrants going into the EV market. So we've seen Tesla cutting prices last year. We see basically an intensifying of competition within the EV industry. So it's not a matter of demand, but it's a matter of supply. Similarly in the solar industry, I mentioned demand is very robust, but what we see is there's been a lot of producers coming out, excess supply, excess capacity, and therefore in order to fight for that market share, everybody has to slash prices, and that eats into the profitability and the profit margin of these companies. And what we are seeing is basically a imbalance in between supply and demand for both of the industries, although demand is still pretty robust. In terms of the question about tariffs on EV, especially going to the US, I think in our view it's more of a political gesture and political move than anything economical, because when we look at EV exports into US, basically Chinese EV exports into US only accounts for around 2%. So economically it's not very material, but politically it's quite a big symbol when the US government comes out with such a policy, especially in a year of elections. So I think that's probably our view in terms of both of these sectors. Demand is robust. There is a little bit of supply and demand imbalances, but over the long term, we're still seeing a pretty strong growth in both of these industries.
Thanks. Any addition from the panelists?
At Aberdeen, we are stock pickers from a bottom-up perspective. So I just give you two, I won't say ideas, I'm not supposed to recommend ideas, but two areas that we focus on. The first one is, as Francisco mentioned, we have issue with overcapacity in the solar as well as the electric vehicle batteries. However, you need to do a bottom-up stock selection, and there is still opportunity to be made. And I always get questioned whether you can get AI names in China. I actually advise people not to come to China for AI. With the US chip ban, it's going to be very challenging to find who will become the pure AI champion. In fact, I would advise you to come to China and look at what China is good at. You can find the NVIDIA of certain component. I cannot give you the name because you know which stock I'm talking about. NVIDIA of certain component in the electric vehicles. Those are the kind of pick and shovel method that we have decided to approach the electrification of vehicles in China. And what do we mean by NVIDIA? Not because of the AI, but NVIDIA has like 80% of AI chips, advanced technology. So similarly, when it comes to electric vehicles, certain part of the supply chain, certain player has very big market share. So you are looking for those guys that are further up on the market, further up on the supply chain, that commands a bigger market share than trying to pick which one will become the Tesla of China in the future. Right? So instead of picking which auto company will become the champion of the future, perhaps you go further up the supply chain. That's the hint that I can give you. The second area that we quite like is, with this change in the way that people are saving money in China, doesn't mean that people are not spending, but people are much more careful in terms of what they spend. So instead of buying foreign brands in China, you are seeing more localization in terms of what they are buying, right? And with less urge to buy property, there's probably more discretionary spending on experience, travel-related areas. So it's not, please don't have the misconception that people are not spending in China. Have a look when you go to some of the golden weeks in China, the number of people perhaps might put you off, right? People are still traveling big time and see what they are doing, and that is still an area where you can find a lot of opportunities within travel, as well as localization of buying what they're buying, not just buying foreign brands like the past. Yeah.
Thanks, Nick. Nick gave us his answer for my next question. So our next question that I had prepared was, obviously AI and tech has been sort of the frenzy for a lot of investors. And in the US we have Max 7, but obviously it has run up a lot, especially with NVIDIA. Are there any opportunities to invest in AI and tech? And I think our server more that we're getting this, and I think close to heart to a lot of us, will the big China internet companies such as BAT recover? How should we think about tech investing in China? Maybe I'll address to Tessa.
Sure. Nick, you have given me a hard time by telling no AI names within China. But no, I mean, it's really interesting when we talk about AI in China. The first question I always get asked by my clients is that, are we chasing the momentum now? Because obviously, if you look at the Magnificent Seven, the share price has more than doubled over the past year. But obviously, when it comes to China, don't expect, we have to be realistic. Don't expect we have some NVIDIA-like AI names in China or Microsoft type of software AI names in China. I think very realistically, there's still a gap in terms of the technology level of China. But AI is a very broad ecosystem, and we have to give credit to China that they have definitely put a lot of investment in innovation investing over the past decade. So even though we don't have some sexy software names within the theme, we do see a lot of more emerging ideas related to the AI hardware, AI infrastructure, or even AI application that can be interesting. So we are not expecting some Microsoft or NVIDIA, but for example, AI servers, maybe a traditional networking equipment maker that they are increasingly getting orders on their AI servers, which is higher margin, or optical transceiver. I'm sure Nick and Francesco may know what I'm talking about, but basically it allows the data to be transmitted in a very high speed, which is increasingly being demanded in data centers because you need a high level of data to be transmitted in high speed, or even thermal cooling system, because now you need more energy. So you can imagine the heat to be emitted to be higher, then you need a cooling system to make sure they don't get overheated and burn out everything. So no, not really exactly the NVIDIA names, but definitely some interesting bottom-up opportunities related to this ecosystem that we find more interesting. So not just the internet names that we are interested in China, I think more and more we find some of these opportunities in the AI space or even in the semiconductor space, just as what Nick mentioned, some of the localization beneficiaries getting more portfolio in the domestic market, they are also interesting ideas for us.
I was referring, I need to qualify myself. I was referring to those pure AI names that may not have profit in the next 5 years. Those are the ones that will be difficult to identify which will become the champion. But definitely ancillary services, like I mentioned earlier on, infrastructure, cooling. Maybe there are other ways to play AI, or even application that is already embedded with some of the technology that you're seeing in China. Those are probably more plausible ways of playing AI than trying to speculate which one will become the next NVIDIA of China, which is going to be very challenging.
Thanks, Nick. We're getting a lot of questions on Slido, so I'm going to start asking the panel some of the questions that are coming in. There's an interesting question now that we're diving into some of the themes. There's a question on SOE stocks. So we talked about the 9 measures boosting capital markets. And also we talked about regulatory policy. Seems like nurturing national champions, it's the rhetoric these days. Should investors look at SOE stocks? Could it be a good option for income-oriented investors? They do give out dividends. And what should foreign investors think about when they invest into SOE stocks? Obviously not as close as onshore investors on what's happening. Who wants to take this question?
Take it, but feel free, the speakers, if you have anything to add. I think SOE is always an interesting topic in China. It sounds very scary to some of the international investors, thinking that they may have a more important objectives to look for. But when it comes to China, it's almost half of the China A index is in SOE. So it's not something that we can avoid SOE or escape from SOE. And equally, I think SOE is not born equal. There are some SOEs who are getting more transparent, more aligned in terms of their incentives with minority shareholders, with the management incentive program, tagged with the bottom line growth. We do see more and more some of these SOE opportunities that we definitely would prefer more than the other SOEs, which may not be having an interest aligning with investors. I think what we have noticed, as Steffanie, you pointed out, and also Nick also pointed out as well, there are increasingly some of the Chinese companies using the cash to increase the dividend payout, and a lot of them are single enterprises. So obviously there's a top-down direction we can see from them. And if I look at some of the SOEs, some of the bigger names, they can easily pay up to 7-8% dividend yield. So definitely, I think those are also interesting opportunities for us. Nick talked about the relative attractiveness of Chinese equities, because I think this is important when it comes to the yield as well, because when it comes to domestic investors in China, they don't have a lot of investment options. Deposits, we talk about interest rate being low, not that attractive. Property also not an attractive investment anymore, with property price coming down. So within investment product, now if I look at the CSI 300 dividend yield is now at 2.8% versus 10-year government bond yield 2.3%. So from a domestic investor point of view, the relative attractiveness on some of these higher yielding equities definitely becomes more attractive, and that should be also attractive to some of these investors in this aspect.
Thanks, Tessa.
Yeah, I actually really like the point on not every SOE is born the same. I mean, ultimately there are SOEs in various sectors which are at the risk of national service, for example, financial sectors and banks, etc. And capital allocation might not be the best, but there are also SOEs within other sectors, for example, the consumer, which those companies are continuing to take market share, and they're continuing to be more profitable and also returning some of that cash and some of the return to the shareholders. So it really depends on the company itself, and not every SOE is a bad company. I think that's a similar point we would echo.
Just want to add that we should not be allowing the tail to wag the dog, right? So we should continue to look at basically the business model of the SOE, whether it is attractive, whether it is high quality enough, and whether they have management that are aligned with you as minority shareholders. and not just look at which one has the highest dividend yield. So that's an important consideration. And otherwise, all this hype about high dividend, that's how it is in China. They also gradually will lose favor after a while. So be careful that don't jump onto the bandwagon with the rest. Be careful of what you select as well within the SOEs.
I think that's a good segue into the next question. I mean, opportunities come with risks, right? There are some questions on, sounds interesting, sounds like we're turning a corner, but what are some of the risks investors should be aware of? There is some sort of potential worry that given the run-up, is it going to lose steam? There are also other questions on will the sort of renminbi direction sort of hurt sentiment? And there's also a question on interest rate differential. So it looks like the US sort of interest rate cuts might not come as quick. How would that impact markets on this side of the world? So maybe ask the panelists to shed light on some of the risks investors should be aware of.
Sure, I can start. I think the risk goes back to the couple of underlying building blocks of what's driving the Chinese economy. First of all, we talked very extensively, I think Nicholas talked very extensively about the real estate sector. I think whether the government is able to put a backstop in terms of the free fall, the downward spiral of the sector is very, very important. We have seen stimulus coming out incrementally and more incrementally. I think Nicholas' and everybody's view is it is a game changer. Ultimately, in our view, there is still a huge excess supply of unsold units of property within China. We just did a little bit of work on the overall industry, and we estimate that even at today's rate, today's purchase rate, the current excess supply will take at least 3 years for the market to digest. That's our view, assuming that there is no further stimulus coming from the government. And that feeds into the overall consumer confidence, right? From the wealth effect that I talked about, and also the unemployment rate from the youth and the younger population. I think those are the two main things which will continue to be a risk which floats in top of investors' mind, and that's ultimately what will drive rekindle the economy of China.
And Nick, I think because you mentioned QE, now there's a lot of questions on renminbi. Will China be forced to do QE and they have to devalue the yuan? What's your view on that?
Yeah, it's a very topical question. QE may not be purely money printing. It could also be a mix of market participation. The central bank has been very concerned about the long-term end of the bond being very low yield. So perhaps issuing bonds at the very long end will also help to raise the interest rate at the high end, at the longer end, and that will in a way try to resolve this rate differential. Ultimately, the renminbi is dependent on the economic recovery. If QE is needed to resuscitate the real estate, so be it. It's better that way. Given that the market has rallied, maybe that helped. But also they saw that some of the policy are heading towards the better direction in terms of the real estate. But so far in terms of the flows, is still, I would say the Americans will probably be the last one to come back because of geopolitics. It will be the regional funds. If you are a regional manager that I used to be, if you look at the region, India is expensive, and you never know with politics as well. Given the election in India wasn't as well as expected. Mexico, I used to be an EM manager as well. Mexico also disappointed, right, with the election results. So you never know, right? If you look at the global allocation, perhaps China becoming more consistent with its policy might be sorry, it sounds like a race to the bottom, but maybe a better place to be, and you have the buffer of valuation. That is still one of the golden golden opportunity that you can see here. That if you don't look at the all this macro earnings growth is still roughly on a cash basis about 10%, 10 to 50%. And in terms of PE valuation is still one standard deviation below all EM markets. 100% cheaper than India. Why not? Why not take a little bit, right? This is the second biggest economy. Why not? Give us some money. Right? So that is the beauty of being contrarian. You never know, right? And I think the reward is now skewed more towards the upside, which is why regional managers have decided to close the underweight to China.
Maybe Francesco, I also saw a new question coming in and ties well to what Nick's saying. I think recently there's a lot of hype around India, and obviously people are also concerned about the valuation, right? You cover overall EM as well. How should investors think about China and India? Should we take what Nick says, sprinkle a bit of money, given how cheap it is?
Yeah, I think for China, first of all, Nick made the comment about valuations. It is basically at a very, very cheap level. So we did a little bit of backtesting analysis, and basically at these current price to book levels, if investors were to allocate into China over the last 20 years, historically allocated at this level, you've made money more times than you've lost money over the next 12 to 24 months. So I think that's an important point to think about, because everything has a price, and usually when news and the market is the most bearish, that's obviously when it's the cheapest, right? But nobody wants to buy it because it's just bad news after bad news. So it's very difficult to actually find to time in terms of finding a catalyst, because when the catalyst is apparent, it's already in the price. So I think that's one point. In terms of India and the rest of Asia, I think definitely India is a market which a lot of investors have been looking at over the last couple of years. Valuations for us is really, really stretched, right? A lot of companies, well, some of the companies are still delivering on earnings, and over the last three years, India earnings growth is still growing. But still, I think the valuations is starting to become more difficult to be justified. I think one comment which we've been talking about within the team is that we feel that when it comes to expensive valuations, investors can be irrational for a very, very long time. But usually when valuations are very cheap, typically it's not irrational for too long. So hopefully, if people are looking at, or investors looking at China, try to take up the opportunity for low valuations.
If I just add one point, I think for China there's an additional element, is the FOMO, the fear of missing out now for a lot of investors. And just as Nick mentioned, a lot of the investors who have cut down or exited the allocation to China maybe last year lost hope already after the tough years. Now they started to see a slightly better outlook, and with the recovery, as Steffanie mentioned at the beginning of this session, the FOMO is really on the rise. I think I was the poor victim. I always went to the roadshow at the bottom of the market. I went to Europe in February this year, right at Chinese New Year. Nobody wanted to listen to me. I went there in 2022, November in Europe. Again, that was right before the COVID reopening happened. I got smashed by all the questions around all these COVID restrictions, property situation. But interestingly, since then, well, I hope that I'm going to Latin America. I'm not soon this weekend. I'm not going to turn the flow. Hopefully, keep the positive dynamics. But then, I think overall our year-to-date flows has come back to positive. I think some of the investors in Europe or Latin America or Middle East, they used to have a lower allocation to China. After last year, they see it as a more attractive level to come back. We do see that some of the investors closer to us in this region will take more time to think about it. But again, with China becoming the second largest superpower, continue to be mismatched in the global indices, we do see some of the supportive flows coming back from the other parts of the world in this market.
Thanks, and we're all out of time. So if any of you have FOMO and would like to chase this rally, Endowus carries funds from all of these three managers. You can check us out on our website as well as on our app. Or we also have a China equities portfolio which covers the strategies managed by these fund houses. I really enjoyed the discussion. I hope all of you did. Let's give us a round of applause for our panelists. Thank you for coming. Okay, sorry, most important slide, I forgot. For those who are not yet clients, we have a promo code here. You can sign up through this promo code and you'll get an extra $300 off when you sign up for an Endowus account. So do that if you have FOMO and go on and subscribe for one of the China equities funds. Thank you everyone for coming. Have some drinks, have some canapes, and have a good evening. Thank you.